not sure how to introduce him exactly. He's a portfolio manager. He's worked with Joe Battistelli for 20 years. Just telling us. So we have Kevin to give us some market commentary as well as some other bits of information this morning.
A private equity investor would, when looking to purchase an entire company, we have been able to position ourselves in markets when we were being well paid to take on the risk, and it also, and the discipline also allowed us to move out of positions during periods where we were not being well paid to take on the risk, or as in the case of the last year, year and a half, where risks were rising. And as a result, we have outperformed in the last 1, 3, and 5 years the vast majority of other managers in our category. In fact, every portfolio is and does. You'll see here, this is a report that is provided by Zephyr, and it compares us to the performance of our portfolio to other managers. And what I want you to pay special attention to is that in the last year, as an equity portfolio manager, we were down 14%. Over the last 3 years, we were down 1%. Over the last 5 years, 6%, and that's a compounded annual number. And since inception, 12%. And then if you go to the back where it says manager versus universe, you'll see out of a universe of 76 managers, we ranked first in the last year. I have 3 managers, and by the way, these are all cap value managers. In the last 3 years, we ranked 7th over a 3-year number, and over the last 5 years, we've ranked 5th out of 66 managers. And the reason that we've been able to achieve those rates of return is because we have a very conservative methodology.
Compared to the equities that you have, the other managers that you have, which ones do you compare with?
Well, we compare ourselves. We apply a very strict value discipline to what we do. One of the most critical thing that we focus on all the time is to make sure that we are being well paid for the risk that we are taking on behalf of our investors. And that requires, number one, having conservative assumptions. And I can think back to the late 1990s, and having worked in a research department, having worked on Wall Street, one of the easiest mistakes to make as an analyst and a portfolio manager is to allow your assumptions to get ahead of you, to justify a stock price. So if it was an internet stock or a tech stock in the late 90s, and you saw the price run up, and you couldn't justify the price target, what do? You raise your price target. Well, we wanted to make sure we didn't make that error. So in the process that we've developed, which is something that we abide by, we always make sure that we make conservative assumptions, number one. And then number two, we always want to make sure that we're looking at a good case scenario, a bad case scenario, and discount back to the current stock price to find out what the internal rate of return is for the investment. And if we're not receiving 10, 15, 20%, depending upon the risk of that investment, we would prefer to sit in cash than to risk our clients' money in a non-economic way. So it's a value methodology, and that's why we compare ourselves to the value universe.
I know that he mentioned that last year the portfolio was down about 14%. I think it's important to look at the overall. The S&P was down over 38%. I think probably the Russell 1000 was 38 to 40%, somewhere in that neighborhood. So 14 compared to those numbers is pretty good use of that cash. Just as important, or more important, is where we take that money from. And we're still looking at a couple of the options there, but probably in a week or two, I'd like to come back and give you something definite that you can look at and go from there.